Guys, it's Stan here. Today we're gonna talk about the best method to finance corporate investment. Okay, so in this case, I'm a company and I'm asking myself, okay, I want to finance a new investment, a new project. What can I do? What's the best way to do it? So as a company, you probably know it, you have three main options to finance a new corporate investment. Either using your cash, using debt, or raise capital from an investor. So now in this video you will learn the pros and cons of each situation and what's the best way depending on your company and the situation of your company. So let's start with cash. Okay, so the first form here, the cash funding, could be interesting for your company if your company is generating cash. That sounds like a no-brainer, but believe me, a lot of companies like Uber, for example, are not generating cash. They are burning a lot of cash. So this is a pretty bad option if you're burning cash because you are just not piling up cash. Very simple. So in this situation here, the first thing to consider is, am I generating free cash flow or not? If you don't know what free cash flow is, video here with the different financial statements, it's gonna be much clearer if you watch this, about half an hour. So if you're generating free cash flow, you could do cash funding here, and I put you the pros and the cons here. Pro, very simple, it's the quickest and easiest form to fund an investment. Think about it. You don't need any documentation, you don't need any paperwork because you already have the fund available on your account. You just have to wire it, the person or the company, and to get the investment started, basically. On the con side, obviously, if you're spending your cash on an investment, you have less what is called dry powder, which means basically you have less cash for future opportunities and for growth. That can be a problem long term, but also short term, because in the short term you will have less cash for recruitment, for example, to pay back debt if you have debt in your company, and also to pay back dividends or do some share buybacks. So this is an option if you have plenty of cash, for example, like a company like Apple, and they have like 200 billion cash on their balance sheet, and they can easily afford to do cash funding. So if you are generating a lot of free cash flow, this could be an interesting option. But as you can see, the cons, in my opinion, outweigh the pros. So this is really an option if your company is doing very well and if you are not running into a pandemic. As you know, you never know when you are gonna run into the next financial crisis or pandemic. So it's always good to have some dry powder. It's always good to have some cash on the side. So that's why I would say this is the least interesting option, unless it has to go very quick and fast. But usually it's always a bad sign when a big investment has to go quick, because usually there's a lot of thinking and financing involved. So I would take my time, do all the different steps, and then think if cash funding makes sense for you here. Now let's move on to raise capital from an investor. Now let's talk about equity funding, which is raising capital from an investor. So that can be compared to a teenager who is running to his mom and saying, "Mom, I'm running out of money. Can you give me some money?" So that's kind of the equity funding, but obviously it's a little bit more complicated. And again, I made some pros and cons. So let's go through them. First of all, in the pros, and when you look from a company perspective, asking an investor to give you more capital is low risk for a company. Why is it low risk from a company perspective? Because think about it. If you're using your cash and your cash is going down and you're running into a crisis or something like that, it could be very threatening for your company. Debt, same for the debt. If you have too much debt, you can run into troubles as well. In this case here, it's a bit different because obviously the investor is putting money into your business, but is asking returns which are not guaranteed, but he has some shares in your business. So what you have to understand here, obviously, if an investor increases its capital in your company, it's obviously risky for him, but it's not risky for you as a company, because cash funding and debt funding is much more risky for you as a company. So that's here, in my opinion, it's a big pro. And second pro, when you look at the financial metrics, there is one financial metric which is pretty important all the time. It's debt to equity ratio, meaning basically how much debt do you have compared to your equity. A lot of investors and banks are looking at it. I made an entire video about financial metrics for different stages at a company, linked here and in the description below if you want to have the full picture. But what it means basically is when you're comparing debt to equity, and when your equity is going up because you got some fresh money for your investor, that's good for your debt to equity ratio. So it improves it, and that's good for your credit rating and all these kind of things. That's valued by the investor, if you want. So that's also a pro for this side here. And it's always good, I mean, think about the bank crisis, it's always good to have more capital compared to your debt. Now moving to the con side, obviously in finance there is no free lunch, so you always have to pay more when it's more secure for yourself. From a company perspective, as I just mentioned, the equity funding is the least risky. So obviously you have to pay for it. And how do you pay for it? Well, it's the most expensive form of funding for a company. Why? Think about it. The investor, he or she or the company, the investor has absolutely no guarantee that he's gonna make some money with his investment. That's how it works. That's why it's kind of a risky business to be an investor. But now think about it. If you were an investor, you would obviously ask for more return because it's more risky. That's how finance works. So just to give you an example, I would go from, if you're financing through debt, imagine you can have like a loan for 3% or something. Here the investor will ask for 10% because that's how it works. It's just a riskier business to be an investor than to be a bank, for example, because the bank has a collateral, meaning they have an extra security here. So from a company perspective, equity funding is definitely the most expensive form of funding. Then there is something else which comes into play and which is also can be risky for the company, not from a financial point of view, but from a shares point of view, from an owner's point of view. Because what is happening here is if you raise capital from an investor, there will be some dilution, meaning let's imagine I have 3 investors in my company. I'm getting a new investor in, which takes a part from the cake, if you want. Then the shares of the others will definitely be diluted. So there's gonna be a lot of discussions about it, at least. And there's also loss of control, which can be potential. It will depend on the voting rights. The new guy who comes in gives you money, but maybe or maybe not, it will depend on his voting rights. He will have either something to say or he just puts the money in. So that's going to be debatable here, but there could be a loss of control here if he has the necessary voting rights. And then, as you can imagine here as a con, it's a pretty complicated form of funding, because it's as you are changing the owner structure, you're gonna go through a lot of debates, a lot of contracts, and it's gonna be pretty complicated, and there will definitely be some lawyers involved, so there will be some legal fees which will push the entire thing. It's gonna make it more expensive. So I would say here equity funding is definitely for startups and for growing companies, because startups, especially when you are just getting started, building your client base and all that stuff, you're not going to have a lot of cash, because usually you burn through cash. You're not going to have access to debt because no bank wants to finance your risky business. Think about Airbnb, for example, in 2009, 2010. No bank wanted to finance them because it's just risky stuff. And this will be the option when you're a startup and growing company, because here you first of all you have a lot of seed capital, then you have venture capitalists and all these specialized companies who will trade risk against a part of your business. So when you are in this phase for your company, and especially if you're going into a very risky investment, something very new nobody knows, then that's going to probably be the only option you have. And think about Facebook, for example, or Amazon at the beginning. Mark Zuckerberg or Jeff Bezos, they still have a part of their business today, but obviously a lot of dilution happened between they were the owners at 100% at the beginning, and now they maybe have 10-15% or something. That's because they went through this equity funding phase and obviously lost a lot of control and dilution through that process, but it made them obviously very successful and very big companies. So that can be very interesting, but I would say it's definitely in the growing and startup phase. Now let's move on to the debt funding. Okay, so in the debt funding, you basically have two options. First of all, there is a bank loan, pretty straightforward, and then there is the issuance of corporate bonds. That's for bigger companies here. Bank loan, pretty easy to understand. You go to different banks and you say, this is the project I have for my company, I'm expecting these returns, and then if the bank likes your story and likes your credit rating and all these things, they're gonna tell you, okay, we offer you a loan for this amount of money, this amount of time, and 4% or something like that. If you want to issue corporate bonds, and that's gonna be for larger companies which need more money usually. I have worked for companies, they were able to issue bonds for billions of euros or dollars. So in this case, what is happening? This happens on a financial market. You don't have to be a publicly listed company. A lot of people make that mistake. You can be a privately owned company, so not listed on the stock market, and still have access to the issuance of corporate bonds. In this case, you usually use an investment bank, and they will market your bonds to bond investors. And basically it's gonna be, okay, we are this company, we have this project for the future and are expecting these kind of returns. We need 1 billion and we are paying 5% interest. And that's how bond issuance works basically for corporates. So you have these two options as debt funding. Now let's look at pros and cons. Last little thing. If you're thinking about leasing, for example, leasing is a form of loan, so it will all this thing will happen to leasing as well. When we look at the pros and cons, first of all, and that's a very big pro, interests are tax deductible. I will switch and I will share my screen right now to show you what the impact can be of interest rates being tax deductible. Okay, now to showcase you why interests being tax deductible is such a big deal, look at this profit and loss statement here. So a very classic, revenues minus costs equal operating profit, minus amortization, minus interest leads to profits before taxes. Then you have your 30% taxes applied on the 55, which is 17, and then you get your profits after taxes. Imagine. Now, in this case, obviously, in the first line here, I have zero interest because I have no loan. And now, let's look at what's happening if I add a loan. Now, let's imagine I'm financing my project through a bank debt, bank loan, for example. That means I would have to pay interest every year. Imagine it's 10 of interest per year. As you can see, my profits before taxes go down by 10, which makes total sense because I'm adding 10 of costs. That's why my profits before taxes go down by 10. But now a little magic happens here. As interests are tax deductible, as you can see, my taxes are going down because it's on a smaller profit. And now let's look what's going on with my profits after taxes. here before taxes I'm losing 10, but after taxes I'm only losing 7. So here you see why it's such an interesting form of financing, because after taxes you use less than before taxes. So the interest being tax deductible has a big tax impact, obviously, and is pretty interesting for that reason. Okay, now moving away to the next point of the pros, which is in this case the debt funding. As I just mentioned it before, is the cheapest form of funding. If an investor here is asking you 10% return because he has no guarantees, the bank will maybe ask you 3 or 4% depending on your credit rating and your leverage and all these things. So it's definitely the cheapest form. Why is it the cheapest form? Because each bank will ask you for a guarantee. It's a little bit like a mortgage, for example. The bank can take your house if you're not paying. That's kind of the same situation here. There will always be some collateral, some guarantee involved for the bank. That's why they can offer you better rates. So these are definitely two big pros. On the other side, the cons, obviously there's no free lunch, as I just mentioned it before. One thing which will happen if you do debt financing is it's going to increase your leverage ratio. What is the leverage ratio? So the leverage ratio compares the total debt of the company to the operating profits. I made an entire video, I called it Financial Metrics, at different stages of a company, link in the description below, as I mentioned, where I'm explaining all the ratios in a very detailed fashion. But the key takeaway here is actually the higher the leverage ratio goes, it means you will have more debt compared to your profits, which means you're going to be a riskier business because you need to repay more debt. So that's definitely a big con if you're contracting a new loan, meaning you are debt financing. And another big con, and everybody who has worked with a bank knows how painful it is to work with banks, because it's always a long process. A lot of documentation, a lot of paperwork, contracts to be signed, obviously. So it's pretty on the heavy side when it comes to administrative tasks. So now that we know the pros and cons of the different funding methods, let's think about which one is the best. So first of all, I mean, and you probably saw it from the rest of the video, there is no one size fits all approach here. It really depends on which stage your company is in and in which shape, basically. So the stages, you will see that basically there are 3 stages of a company: startup phase, growing phase, and maturity phase. My advice, and that's you can Google it, you will see a lot of people, including big investors, say that if you're in the startup phase, never start a business with a loan. So the debt financing is completely out of the picture when it comes to starting a business. The reason for that is very simple. Debt is certain, which means you have to pay it no matter what. Starting a business is very risky, so it's very uncertain. So you want to mix up a certain financing with an uncertain business, especially since you're a risky business, they're going to charge you a ton of money. So debt financing, definitely not for a startup company. Then when it comes to growing, usually the best option to go is equity funding. Think about a company like Uber, for example, in their first 5 years or something like that. Equity funding was big here because they wanted to grow fast, they needed a lot of money. The best way to finance growth or a big investment, if it's pretty risky, is definitely here equity funding. You know the cons, so you can definitely outweigh pros and cons, but equity funding is definitely for the growing phase. What you have to understand, and when you look at the financial metric video I made, you will see that in the growing phase, so when the company already has a proven track record after it was a startup and is starting to grow very fast, then usually it's a mix between equity funding and debt funding. Now that we have talked about financing in the different phases, we should definitely talk about the shape of the company. If your company is in bad shape, especially, and meaning you're not generating a lot of cash, then obviously cash financing is out of the picture. And then it really depends on how you want to weight these two. What is very important is you should definitely have a balanced picture. If you have too much debt, it's not good. And if you have already enough equity, which costs you much more money, as you remember, it's pretty good to add some debt, if possible, to play with this leverage as well. So if your company is in a good shape, obviously you can also use the cash financing, but make sure to not use too much of your cash because you are jeopardizing the future of the company. Another important thing I wanted to mention when we're talking about funding is there is a basic rule in finance. If you have a long-term project, you need a long-term funding. You're not mixing up short-term financing, for example, with an overdraft facility or with a credit card debt, for example. You're not mixing it up with a long-term project, like a project for the next 5 years or something like that. Now that you know the different funding techniques and the one which is the most interesting for you, I wanted to tell you that I post once a week every Sunday. Next week I'm gonna talk about IPOs, initial public offerings, and also the alternatives to IPOs. So make sure to subscribe if you like that content. I post once a week every Sunday. Make sure to like that video if you like that content and comment if you have questions. See you soon guys on the channel. Bye bye!